Hello everyone, welcome to Building Accountant. Today we'll be discussing the recording process. The accounting cycle. Firstly, we have the occurrence of transactions, then recording the journals, ledgers, and monthly trial balance, then the pre-adjustment trial balance. Then we have our adjustments, then we go to the post-adjustment trial balance, then we have our closing process, and then post-closing trial balance, and then finally we have our financial statements. We have the summarized version of our accounting cycle. Firstly, our transactions that take place on a daily basis. Then we have our source documents completed on a daily basis. In the journals, entries are made on a daily basis. And then our ledgers posting either takes place daily or monthly. The trial balance drawn up on a monthly and annual basis. Then finally our financial statements done annually. After a transaction is occurred, you need to analyze it and start the recording process. The first step is a source document. A source document is the original document that contains the details of a business transaction. A source document captures the key information about a transaction, such as the names of the parties involved, amounts paid if any, the date, and the substance of the transaction. Source documents are frequently identified with a unique number so that they can be differentiated in the accounting system. The pre-numbering of documents is particularly useful since it allows the company to investigate whether any documents are missing. Once the information in the source document has been recorded in the accounting system, the source document is indexed for easy access and archived. Then we move to recording in the journals. A journal is a sequential summary of similar debits and credits for a number of transactions for a specific month. The different types of journals, namely period journals such as purchases journal, sales journals, purchase returns journal, and sales returns journals. And then we have our cash journals, the cash receipt journal, cash payment journal, and the petty cash journal. Then we have the general journal and other journals like wages journal, salaries journal, debtors journal, creditors journal, debtors allowances journal, creditors allowances journal. Most entities use the general journal to record every transaction so that they can keep everything in one. Common transactions that take place in any entities are cash transactions. We have cash receipts recorded in the cash receipt journal and cash payments recorded in the cash payment journal. The example of cash receipts are rent received from tenants, money received for cash sales, payments received from debtors, cash received in return for services rendered. Examples of cash payment: that's stop orders against the account of the entity, payments of water and electricity account by check, monthly electronic funds transferred of the account of a creditor. After recording in the journal, we record in the general ledger. The double entry concept says each accounting transaction has two or more sides. The general ledger, also known as the T account, is a record of the two sides of a transaction, a debit and a credit. T account focuses on identification and classification of useful accounts. Accounts will be categorized differently depending on if they are assets, liabilities, equity, income, or expense. From the general ledger, we'll record on the trial balance. The trial balance is used to detect mistakes in the ledgers before financial statements are drafted. There are different kinds of trial balances that are drawn up during various stages in the accounting process, namely monthly trial balance, which is a list and total of all debit and credit accounts for an entity for a given period. The format of the trial balance is a two-column schedule with all debit balances listed in one column and all credit balances listed in the other, to control the application of the duality concept. The pre-adjustment trial balance shows the raw figures from the general ledger before any adjustments done. annually before adjustments take place. Post-adjustment trial balance shows the figures after the adjusted for various accounting entries made at the end of the period. These include accruals, adjustment to reclassify things, correction of errors, entries as a result of reconciling various accounts, etc. Post-closing trial balance. This is prepared after closing entries are made. It is purpose is to test the equality between debits and credits after closing entries are prepared and posted. The post-closing trial balance contains real accounts only since all nominal accounts have already been closed at this stage. We're in the recording process of transaction that will care so we can produce the information to stakeholders so that they can make the right decision. It is important to use an inventory system that will accurately show exactly what we have as an entity. We have two inventory systems, namely perpetual inventory system, periodic inventory system. We'll have a look at how the perpetual inventory system looks first. The entity will have a record of the inventory levels at all times. All purchases of goods for resales are recorded in the inventory account. A cost of sales account is kept. Every time goods is sold, the cost of sales account is debited. When goods is sold, the cost of such goods is credited to the inventory account to enable the entity to keep track of its inventory level at all times. Then the periodic inventory system. The entity will only have the inventory levels when a physical stock take is done. All purchases of goods for resale purposes are recorded in the purchases account. No adjustments are made to the inventory account when goods are sold. No cost of sales account is kept. The cost of sales is calculated by adding the opening inventory and purchases and deduct the closing inventory as determined by the physical stock taking. This is the final step and the actual goal, which was broken down to the little steps, the accounting cycle. At year end, we prepare financial statements for stakeholders like our investors, the government, suppliers. The aim of all of this is to prepare financial statements for external users so they can make informed decisions. A communication medium through which financial information of the entity is communicated to various people that make economic decisions. The financial statements include the statement of profit and loss and other comprehensive income, statement of cash flows, and the statement of financial position. Let's recap on our accounting cycle. There are source documents after the transaction is occurred, which include the receipt, cash register roll, deposit slip, check counterfoil, duplicate and original invoice, petty cash voucher, a debit or a credit note. This happens daily. Then we have subsidiary journals on the perpetual system. Then we're going to have the CRJ, CPJ, PCJ, DJ, CAJ, DAJ, CJ, and GJ. And then the periodic system, we have the CRJ, CPJ, PCJ, SJ, PJ, CRJ, PRJ, and GJ. Forced into ledgers, we have a general ledger, a debtors ledger, creditors ledger, and preparation of monthly trial balance, which is recorded monthly. And then we have the pre-adjustment trial balance, which is recorded monthly as well. Then we have the year-end adjustment, which is recorded annually. And then we have the post-adjustment trial balance, which is also recorded annually. And then we have our closing transfer and final accounts, which takes place in the trading account and profit or loss account, which is recorded annually. And then we have the post-closing trial balance, which is recorded annually as well. And then we have our financial statements, which includes the statement of cash flow, statement of profit and loss and other comprehensive income, and the statement of financial position, which is recorded annually. Thank you, ladies and gentlemen.